We'll have to keep an eye out on some of those city gas companies, names like Manappuram, Zomato, etc. as well. 0.5% higher in the first trades which are coming up. So 24,965, a bit more climb here. Nifty Bank is starting about 0.45% up, 52,360. The Sensex is starting about 0.5% up. Mid-cap index has got 0.5% as well. So it's overwhelmingly green. About 38, 39 stocks perhaps in the green, with a few in the red as well. It's about 10, 12 names in the red as well. But holding steady, 0.5% actually, maybe building up a little bit more in the initial first actually minute of open. So 100 plus points on the Nifty after the 100 that we saw on Friday as well. Surabhi.
It's a big fight between the bulls and the bears today, a classic one really. You've got Tech Mahindra and HDFC Bank on the upside. So HDFC Bank is the big one that's trying to be a counterweight for the Nifty. Gain of about 2.5%. And Tech Mahindra's numbers, you really can't find fault. Margins rising by over 100 basis points. So it's actually taking some of the other IT stocks up with it as well. Wipro, for instance, is on the higher side. There's Tata Steel, Hindalco, two metal names that are doing well. There's Titan with gold doing what it is, and it seems that the festive sales are not all that bad. 0.5% up on that stock. Reliance is making sure that we don't see a wider fall. And Infosys is trying to claw back from the blows that it received on Friday. So some of these heavyweights on the upside. But now the downside, look at the reaction on Tata Consumer. Consumer is really turning out to be a disappointment. I mean, there was Nestle and there's Tata Consumer. We've heard the commentary from D-Mart, etc. It's 5.5% lower on Tata Consumer. And then there's Kotak Mahindra Bank, which is down 3%. Asset quality is stressed, rise in slippages, margins down 10 bips. Market doesn't like any of that. It's 3% lower on that stock as well.
Tata Group companies as well. Look at Tejas Networks. I mean, Tejas Networks, we don't talk about it, is a top volume-led gainer on the NSE.
Yeah.
20%.
Absolutely. And then, overall Nifty is holding on to that gain of 100 points, but really it's about individual stocks. My God, look at the reactions. 10% down on RBL Bank, IndiaMart 10%. So markets in not a charitable mood at all wherever there's a miss.
Well, that's right. Bumper numbers actually from Tejas Networks. I'm just looking at it, on a year-on-year basis, on a quarter-on-quarter basis as well. Sales number of around 2,800 crores. Margins have improved drastically. They're doing 500 crores of EBIT. And net profit as well, 275 crores. So I think that's the reason why Tejas Networks is now up close to around 19%. Clearly, the stock of the morning. Tata Chemicals as well is up close to around 5.5%. So good move is what we're seeing out there. UCO Bank is reacting positively. So that stock as well is up close to around 3% as we speak. RBL Bank is taking it on the chin now. That one's down close to around 9% as we speak. So a hard knock is what we are seeing. And Dalmia Bharat, we made this point earlier. The stock was down close to around 4.5% in pre-open. Now it's down close to around 1% odd. The con call will be there later today. So we'll wait for sound bites. But since the street was net short on the stock, and since you're expecting a better second half of the year, there is some kind of recovery. Those sustenance will be very important on this one as well. By the way, IndiaMart, the shop is closed, for the time being. It's hit that circuit, so there'll be a temporary freeze on that one. It's down close to around 10%. At 10:30 today, we'll be having the management of IndiaMart. So you stay tuned for that conversation. Let's find out how do they see things panning out. But it's a good start, a 100-point uptake out there.
RBL Bank, 17% down. I mean, that's the extent of the intensity, the selling intensity
9%
on this one. Okay, maybe my screen didn't refresh, so make that 9%, which is a
couple of other gainers. I think Oberoi Realty as well reacting to its numbers, so that one's up close to around 2.5%. So good going on that stock. By the way, the big headline this morning is HDFC Bank has moved past its 20 DMA post its numbers. The street liked the clarity that was given in the con call as well. And that's now the one that the bulls are counting on to take us high. So HDFC Bank is the one that's doing all the heavy lifting. And what it's done is it's breached the 20 DMA, and the Nifty Bank as well has taken out its 20 DMA. So now the Nifty Bank seems to be the one that is driving the markets higher from here on. Sustaining these levels will be crucial. But good to see HDFC Bank returning back to its winning ways. Post that merger, a lot of rough edges. Some of them are getting cleared out.
Okay, well, let's just look at some more names here. Mazgaon Dock is up 6%, if we can have this up. So shipbuilders, by the way, on Friday as well, one of the few, not one of the few, but from the beginning, I mean, they never really were down. So Mazgaon is up another 6% this morning, and Garden Reach is up 5%. So these are large gains coming on, now large companies. NetWeb, we just spoke with the management. NetWeb Technologies is up 9%. So that's at 2,900 plus. So, these are pretty large movers. Tata Investment Corporation is up 5.5%. So actually the two Tata companies, Tata Chemicals is up 5%. And Tata Investment Corporation is up about 5% as well at this stage. Amber is up about 4%. Amber at 5,600. JM Financial, I think we mentioned it, 6% higher. So it's seeing a bit of a reaction. Tata Chem has cooled off a little bit, but it's still a solid 4% more, near 4% gain. There is 361, which is up about 2.75%. So it's got volumes, by the way. Pilani Investment is up about 10%. It's coming up with volumes, so just making a quick mention of it. I mean, that's it. Market breadth is kind of closing in. It was clean, neat, 2:1 in favor of advances, but it's not so clean now. And we're sort of working our way through some of the opening levels. Manappuram was a sharp loser on Friday. It's down another 2.5% this morning. So just under 150 rupees right now as we speak. Viatec Vabag was a big winner. Through the last 5 days, it's pulling back a little bit, about a 2% odd cut. SW Solar is down about 1.5%. Yeah, I mean, lots of names starting out. Yeah.
I don't know if you guys saw JM Financial.
Yeah,
so 6% holding on to that gain with the RBL relief coming in.
Absolutely. Well, we have our market master of the day, Harsha Upadhyay, President and Chief Investment Officer Equity at Kotak Mahindra Asset Management Company. Harsha, good morning. Good to have you with us here. Thanks for your time. Is the market largely, I mean, obviously, if you look at single stock reactions, markets are reacting violently to earnings. But as we went into the this earnings season, expectations were generally running low. So is it this, I mean, Q2 the markets are reacting to, or fears that maybe this festive season and hence third quarter may be a bit soft as well? What's the dominating driver, Harsha?
Good morning. As far as we are concerned, we were expecting Q2 to be as muted or even more muted than June quarter. So to that extent, it's not been a surprise. But yes, all eyes have been on the festive season in terms of what kind of a pickup we would see across various consumer focus segments, and whether that will lead to some amount of improvement in terms of the profitability trajectory or not. In case that doesn't pan out, then probably the full year numbers, which have already been cut after the first quarter earnings, will need to be revised downwards once again. So that is probably a worry that's across the market at this point of time.
Harsha, hi, morning. So just to expand on that thought process, when I'm looking at a stock like Tata Consumer today, the sharp reaction that the market has given it, I mean, down 5-6%, right? It's not like it went into the earnings some 30-40% higher. The stock has not done much through the year, and still it gets slammed very, very hard just because the growth numbers are not really lighting up the screen. So what do you think is sort of the way forward for consumer? What's really happening here? Is this really getting the market worried about a broader slowdown and maybe the rural recovery not picking up? Or maybe this is simply, buying patterns shifting, consumer preferences shifting. To look at the updates we got from gold financiers, from jewelry companies, 25-30% growth for most of the jewelers. So is it more of that? More discretionary, less staples?
Good morning, Sophie. Clearly, I think discretionary consumption, while it is also slowing down in patches, has been better than on non-discretionary consumption at this point of time. Rural continues to be weaker than urban across many segments, I would say. The hope was probably you will see some amount of pickup in the rural-oriented consumption pattern, and that has not been seen at least up until now. So that's what probably been not liked by the market. And also not to forget that most of these stocks have been at valuations which have been more or less in line with their average valuations or above average valuations. So to that extent, there was not much room for disappointment in that sense. Probably that's what is leading to this kind of a reaction in the market. While at the overall level, probably the earnings are more or less in line with the expectations, but depending on whether each of those businesses are delivering the numbers as expected by the market or not, there could be a reaction as we go.
And Harsha, your house view, I mean, what are you doing with consumers? Is it market weight, neutral, overweight? Are you looking to buy the dip, be a contrarian here? Just generally, what's your house view?
Generally, we have been more positive on urban and discretionary consumption rather than mass-oriented non-discretionary consumption. Having said that, we have also added some position over the last couple of months, so mostly are trying to build a little bit of a defensive tilt to our portfolio. However, across portfolios, it could still be underweight to equal weight kind of a position. We have not gone too much into consumption across many portfolios.
Hi, Harsha. Good morning. Good to see you. And Harsha, I think you're overweight on IT as well, a few months ago at least. What is your current view on tech?
That's right, Nigel. We have clearly added IT across most portfolios over the last couple of months. And from an underweight position, it's probably an overweight position across portfolios. While we have not seen significantly different numbers during Q2, but we believe that there has been a broad-based stability across many verticals as you see results coming in. That's very, very evident. And also, this time around, the commentary around furloughs seem to be usual rather than anything to be extraordinary. So to that extent, I think things have been okay in the very short term. And also, there is a hope that depending on which way the US elections go, then there could be some upside for IT companies, because if one particular party wins, there could be significant tax cuts as promised by them. And if that were to happen, then the corporate spend on IT in US can pick up significantly. So these are some of the things that we are also looking at. And currently, we are overweight on this basket.
All right. And the overweight stance that shifted from underweight to overweight came at the cost of a couple of sectors like autos. How are you all placed currently on the auto segment? We have a new listing, big one that's expected. And also Bajaj Auto's numbers last week, that was the result reaction of the quarter, I think, so far, with the stock tanking more than 10%. So your positioning on autos now?
Autos has been an underweight position as of now. We significantly reduced our position over the last 1 or 2 quarters. And the thesis there was the valuations have been rich across many segments of auto and auto components. And we were already seeing some sort of weakness as evidenced by increase in inventory across the pipeline for passenger vehicles, for example. And also, this festive season is going to be very crucial for the entire auto pack. If the volumes don't pick up around this festive season, then it could bring further downside to some of these stocks as valuations remain quite rich. And on the margin front as well, we think probably the best has been seen, at least in the short term, given that many of the manufacturers are looking to give further discounts to push volumes into the market. So overall, we believe that financial year 25 earnings for auto is going to be a lot weaker than what everybody anticipated, and also weaker than financial year 23 and 24. And based on that, we have actually cut our position in auto. It seems to be working at this point of time.
Harsha, the big winners last week, stock-wise, right? Friday to Friday, Motilal Oswal was up 30%. Angel One was up 16%. A couple of other capital markets plays. AMCs, Aditya Birla AMC, HDFC AMC. What's your positioning here? And actually, even wealth managers, if you can give us a sense.
We have positions across capital market focused players, be it brokers, wealth management firms, or asset management companies, depending on which portfolio you look at. And clearly, this is one segment where the penetration levels are very, very low, even at this point of time. And as penetration is likely to improve over the next few years, there are definitely good businesses that you can back and make money for the long term. Clearly, this is one space where we would continue to have positions in most of our portfolios, I would say.
Okay, all right, Harsha, we appreciate you joining in and giving us your view. Looking forward to having a chat with you as things progress. Wishing you a good day ahead as well. Well, let's focus on Hindustan Zinc. The quarter 2 numbers came a little better than what the street was working with. The operating leverage played out. Power and fuel costs did come down. The cost of production as well dipped. We have with us Mr. Arun Mishra, the CEO of Hindustan Zinc, who joins us on the show. Good morning, Mr. Mishra. Good seeing you today. Well, metal prices have bounced, and there is hope that China will bounce back. You had earlier told us that you expect zinc prices to hit around $3,000 per ton by the end of this year, but it already hit it in October itself. What is the zinc price band we should work with, given the demand-supply dynamics?
So I will stick to my earlier prediction. I had stated that by December it should reach $3,000. It has reached by October, and it will continue to remain in this range only till the end of the year. I guess after the US elections are over and the results are out, new government kicks in, we would know in which way the economy will turn. If the new government, whosoever comes in, keep the same push of infrastructure and there's green economy intact in USA, it has a cascading effect on the rest of the world. Although we don't sell directly in USA, but we know when USA starts importing lots of consumer goods, the overall sentiment on metal goes high and also the zinc prices go up. So I think by January onwards, we'll see, depending upon the US results, moving towards $3,100 per ton kind.
Okay, Mr. Mishra, good to have you on the show, sir. Silver prices have been quite volatile as well. Earlier, you expected about $31 to $32 to the ounce, I think, but then it's corrected. There's a bounce back. What are you really looking at and expecting from the silver market in the coming months?
No, I had guessed $32, kind of a 31, 32 number. It has gone till that, and it will continue because silver is still in short supply, and the industrial consumption of silver is growing as we speak, and it will grow even more because almost all countries are pushing for renewable power, more and more solar panels, more and more low resistance, high conductive circuits. So more silver in the industrial applications will continue, and the prices will try to remain above $31, $32 a troy ounce kind of number.
All right, Mr. Mishra, you've given us your volume targets. My question to you is, can you hit the upper end of the band with regard to volumes? And also, could you give us a sense about what is the contribution coming in because of the fumer? How is it functioning?
No, so the fumer, we had a really difficult time because one, we did not get the Chinese experts because of visa issues. And also this technology is completely new to us. So we struggled a bit. But now I think we have got a good grip over it, and we have taken the entire plant on shutdown because we wanted to do new lining of that entire fumer, do some revamping, do some debottlenecking. So we are doing all that, and it will come back by end of this month, back to operation, and we should see balance part of this quarter, which is November, December, and the Q4. Fumer will run in full capacity and we'll get. But saying that, although we did not run at a full capacity and we had a lot of troubles, it still produced about 3 tons of silver. So we are happy at that.
Okay, got that, Mr. Mishra. Now, what about the overall volumes? Can you hit the upper end of your guidance?
Oh, not higher end. We should be going closer to the higher end. See, even if we repeat H1 performance, we should be ending at 1048 KT. So which is bare minimum. And then Q3, Q4 are normally far better than Q1, Q2 combined. So we will be anywhere crossing staying within our guidance that we have given.
But Mr. Mishra, what about silver then? You're given that band 750 to run 775. Can you achieve more than 750 tons?
Not 750 plus, so we should be closer to 750. It is possible. Because we have already produced 350, and if we don't do anything, then there is a probability of producing 700. Of course, the fumer is coming back online, and say 6 months, out of which it was 5 months at about 3 tons each, will be another 15 tons of silver. And then the all around H1, the grade of silver was 88 ppm in Sindesar core. Their bad phase would be over, and we should come back to 110, 120 ppm. That itself will add more silver to the kitty. So it's not very difficult to reach the guidance.
Well, Mr. Mishra, in your press release as well, you're sounding quite optimistic about the cost of production. It hit the lowest we've seen in 4 years for the first half of the year. Can you hit the lower end of the guided band that you've given us on the cost of production?
No, if not, right now at H1 level, we are at around $1,090 per ton. We are still within the guidance only. And we should go closer to $1,050 per ton, if not year average, but at least H2 we should be closer to 1050. Why so? Because our renewable power mix is increasing day by day, which was say 9% last quarter, has gone up to 14% now, and will go to say 23% by Q3 end, 30% by Q4 end. If these numbers are coming true, then automatically my cost will also go down.
Okay, so you're optimistic on keeping the costs low. Your shareholders will like that. Sir, just talk about the silver business and the whole concept of value unlocking. I think there was some talk about you looking to separate that business out. So where are we on that?
No, so we are still in discussion, but at the same time, there are many disinvestment is likely to happen as we understand from whatever we hear, and at the same time, this is also we are looking at. There's a timing issue. We have already started discussion on doubling the production to 2 million tons. So there are too many things on the plate. And I think our first activity would do the logical sequencing is disinvestment. If that happens, other things will fall in place.
Interesting. So let's talk about the divestment then from the government of India. Could you tell us when could that possibly happen? Could it happen in this quarter? And I want to understand, last time around everyone was looking at the government of India, but Mr. Agarwal, that's Vedanta, came and divested their stake to some extent. Do you think Vedanta will come and sell some more stake, or do you think the government goes first?
I can't comment on what is the Vedanta would sell stake or not. Whatever Vedanta had to do had been done for their need of deleveraging. If we look at government, I think the action is long overdue, should happen as soon as possible.
Soon as possible could be this calendar year?
I can only hope for.
Okay, all right. So let's see when that happens. But let's wind this down then. A lot of your shareholders look at the company not just for the operational performance, but what about some dividend? Is there any big dividend payout likely? And also give us your capex plan. Just give us an update for this year.
I can't comment on the dividend policy as such. On the dividend likelihood, because that's a board to take a call. As far as capital is concerned, we are still within that guidance only, and we should be spending close to $300 million in capital.
Okay, well, lots of details there. Thank you very much for your time. Appreciate it here as always, sir. Well, let's just look at the market now. We're down 40 points. I mean, it's a sharp turnaround from the day's high that we've seen. So this is, I think, should be about 150 odd point turnaround. And this is what we were talking about in the morning, that holding on to the bounds that we saw on Friday, it was a 100-point higher close Friday on top of Thursday, will be critical. So we've got the first sort of move which has come, and that has been on the way. The second, actually, the first one, of course, was the way up, but it hardly stayed because almost immediately, 917, 918 onwards, a downdrift started, which is accelerated. And we're on about 40, 50 odd points now. Nifty Bank should also come up on your screens. That is still holding on, but it's already a red candle, which means we are below where we left off on Friday. So, trying to see a bit of a recovery, but quite a bit off. The high of the Nifty Bank was 52,577, and we're at 52,200 or so. More on markets in terms of individual stocks, etc. We'll also put the focus on what to expect as far as consumer sector is concerned. Quarter se quarter tak, FMCG in focus. That's coming up.
Welcome back. Well, today Mangalam will focus on the second quarter's numbers, and the sector of the day will be FMCG. Mangalam, over to you.
Well, as far as the FMCG sector this time around is concerned, we're looking at some dark clouds before the festive season optimism kicks in. Why do I say that? Because, just to set the ecosystem in order, there's been a gradual rural pickup, but that's been offset by stagnant urban demand. So that's on the demand front. competitive intensity has been very high, and this is on all fronts. Retail feeling the heat from quick commerce, jewelers feeling the heat from lab-grown diamonds, soap makers is seeing increased competition from each other, whereas paint companies are battling out the competition from the Birlas itself. Out-of-home consumption has been impacted by excess rains and flooding. Here too, competition in the beverage space, particularly from Reliance's Campa, has impacted some of the players. To add to the woes, we have raw material prices which have begun to firm up post-deflation, making margin expansion all the more difficult. And that's something that we've seen in the results that are out already. There have been weak internals from Tata Consumer. Nestle's volumes fell 1.5%, margins missed street expectations, and DMart called out specifically a quick commerce impact on its sales. And that's not just the numbers that have come by. Even from the Q2 updates that we have already, Dabur volumes and margins have been impacted by beverage inventory correction. Marico's domestic business posted mid-single-digit volume growth. Bangladesh has been resilient, so that was one of the better numbers that came by. But GCPL cited inflation and competitive intensity for India margins to be weak. For the jewelry companies, revenue growth has been led largely by higher gold prices, increased boost from the budget and store expansion. But they too are facing uncertainty from lab-grown, and there is concern that have people preponed their purchase ahead of wedding season in the second quarter itself, and will that happen in the third quarter as well? From a company-specific standpoint, analysts see a mid-single-digit sort of volume growth coming in for HUL, 2 to 3% cigarette volume growth expected for ITC, and a seasonal weakness expected in players like Asian Paints, Berger and Pidilite because of, again, excess monsoons and flooding. And from the recent industry trends and the recent results, let's look at some of the outperformers. Colgate, Honasa and Jyoti Labs are likely to be key outperformers in the staple space. There have been early signs of recovery in quick service restaurants, so this is a sector we'll be watching out for. And stocks of the dairy and edible oil sector may continue to see margin expansion due to favorable macros. But however, beyond all of these numbers, the most important thing to track will be the commentary on the festive season, because on that hinges many hopes of recovery in the near future.
Oh, absolutely, Mangalam. Thanks so much. And, our market master was echoing exactly this sentiment. I mean, people like Harsha, perhaps, who've gone slightly overweight on consumer, have gone so expecting that recovery to really come through. Will it, is the question. Abneesh Roy, Executive Director at Nuvama Institutional Equities, is now joining in. Abneesh, hi. While the market was dealing with a lot of potential issues here and there, from geopolitics to, commodity prices to what's happening with bank margins, I don't think disappointment from consumer companies was really sort of penciled in to this extent. From Bajaj Auto to Nestle to what DMart said, this is, Tata Consumer's reaction today, not looking too good. Your initial thoughts?
Yeah, thanks. So yes, if you see our preview, which was released a few weeks back, the heading was that the quarter will not reflect the kind of re-rating stocks have taken. So we are seeing profit booking because the rural recovery is there, but urban slowdown is clearly there. Why is the urban slowdown? Clearly, food inflation is very high. That does impact urban consumer much more. That doesn't impact rural that much because freebies are happening in the rural. Plus, a lot of the foods is locally produced for the rural consumer. So he doesn't face that same issue. Second, of course, is Q2, the impact of the competition was there, the weather was there. Going ahead, our sense is Q3, Q4, the rural recovery will further sustain. But urban, we continue to remain cautious. Our sense is competition, quick commerce, and urban slowdown is something next 1 or 2 quarters will remain. So that's why we will be more positive on names which have more rural presence and which have propensity to gain market share. So till now, yes, you are absolutely right. Most of the results have been on the negative side. But we do see that Britannia, Colgate, even Pidilite, Bikaji will report a good set of numbers. So it is not that the entire sector will see the numbers which we have seen till now.
Okay, that's heartening. We need a ray of hope when it comes to the space, right? Because we only got negative news. But even on rural, I mean, I go back to Dabur's commentary, right? And I think Dabur was the first one, suddenly got the debates stirred up, and I remember we spoke as well. On rural, since that's where your optimism is, what is the recovery you're penciling in? And what about this whole quick commerce disruption, because of which inventory levels and, channel and distribution sort of situation is really moving around quite a bit?
Yeah, so good question. So in terms of Dabur and rural overall, what we are seeing is Campa Cola clearly big disruption in the beverage space. We have put out multiple notes and we got the investor pushback that no, the taste is not suiting the Indian customer versus a Pepsi and Coke. What we are saying is clearly 10 rupee pricing by Campa Cola is quite disruptive. And they have really overcome the supply chain issue of the glass bottles by coming out with the PET bottle. This has led to Pepsi and Coke cutting prices. This has led to distributor margins getting expanded. So beverage space, clearly we are cautious. We do expect India business of Varun Beverages or say Dabur Juice business or say Gluco Plus business or Tata Consumer. Those would continue to remain under pressure in the coming quarters also. Coming back to rural, yes, we will see good numbers, as I said, from Britannia. We see almost high single-digit to double-digit volume growth even in Q2 when the numbers come. Bikaji double-digit, HUL also 5%, not bad number. Colgate around 8%. So I will say in rural, we are seeing recovery and Nielsen numbers are also corroborating that. If you see NREGS number, which is a proxy to understand how the rural jobs are, that is seeing a downtick for now the last 9 months. So that means the rural guy is getting better jobs. If you see private consumption, which has been disappointing for the last 2 years, we are seeing some improvement, 7% growth coming there also. MSP hikes, exports being liberalized in terms of agri exports, that will lead to more incomes. BJP has won the Haryana, so we are seeing a lot of freebies now being offered in Maharashtra, for example. My sense is next 4 years, because of coalition government and because of competitive politics, we will see rural being higher than urban consumption for most of the FMCG players and even for the apparel players. So we are positive on the rural. We are cautious on the urban demand for sure.
Okay, all right.
Coming to quick commerce.
Yes, go ahead.
Last question you had. Sorry, I didn't answer that.
FMCG, the FMCG disruption, DMart, Dabur, all of them talking about quick commerce.
Yes, you're absolutely right. DMart clearly pointed out towards competition from quick commerce, and now we are seeing Zepto, Zomato, Swiggy all raising funds almost every month or say planning IPO. So that remains a concern. So our sense is general trade will keep losing market share, and FMCG, if you see in some cities, now quick commerce, e-commerce and modern trade is bigger than general trade in some of the cities already. So that is something with general trade, Kirana outlets have to grapple with. I think FMCG players will be more than happy eventually to transition more towards quick commerce, e-commerce and modern trade. But for DMart, I think it's a question mark because they don't have quick commerce and they need to really address the market share loss issue which is happening and some urban slowdown which is also impacting DMart. So we are cautious on DMart. We'll prefer Trent and VMart in that space, in the retail space.
All right, let me squeeze in one on the paint space then. Abneesh, I recall that, you all had turned positive, I think a few months ago or so, and because these stocks have underperformed. Now you have crude oil prices that have declined, which will help them out on the margin, and prices as well have moved up. What's your view on the paint space and what do you like most? Abneesh?
Yes, Q2 numbers, as we had highlighted, will be weak because of excess rains. Am I audible?
Go ahead. You're audible.
Hello? Yeah, am I audible?
Yes.
Sure, sorry. So Q2 results we had highlighted because of the excess rains, there will be some weakness in terms of the overall results. We expect 6-7% volume growth, but we expect EBITDA to decline because of the high base. Outlook is positive. As you rightly said, pricing is improving and crude oil is not a concern, titanium dioxide not a concern. Marriage demand should come back for the jewelry players, for the paint players, for the sector, wherever marriage kind of demand is there. So outlook is positive, but Q2 numbers will be weak for Asian, Berger, etc. because of the excess rains and high margins in the base. In terms of Birla Opus, yes, there is an improvement quarter on quarter. But if you see 70,000 crore industry, if they take say 300 crores or 400 crores on a quarterly basis, still it is not impacting in terms of the market share any meaningfully. So they can coexist with the legacy players like Asian and Berger. Our sense is Kansai and Akzo will face the issue of long term, where do they see themselves in India? So Akzo has already highlighted that they are reconsidering their entire presence in India. My sense is Kansai also need to do that at some stage.
All right. Abneesh, we'll leave it there. Thank you very much for joining us. Great perspective on a variety of issues there. Appreciate your time here on CNBC TV18. Look at the market sell-off. I mean, it's down 100 points now, which means we're about 250 points gone from the day's highest level. So that's the extent of the fall. And I think we need to address this, which we will in just a bit from now. But let's focus on the next management. ICICI Lombard is with us now. Now, numbers for the quarter were a decent set. Net earned premium, operating profits came in line. Combined ratio was up about 60 basis points, about 104.5. We have Gopal Balachandran, Chief Financial Officer at ICICI Lombard now, joining us to take some questions. Mr. Balachandran, good morning. It's always a pleasure. Thank you for your time. Prashant this side. You know, before I get to the numbers, there was the GST sort of committee meeting, the GOM meeting, and there the deliberations have resulted in sort of thinking about or proposing a cut, a GST cut for health insurance. Could you talk to us about what? So there are two things. One is for senior citizens. Second is for cover under 5 lakh rupees. What we reported. Could you tell us what is the, what's the proportion of these segments to the overall health pie for ICICI Lombard, and what will be the implications if this is exempted, if these are exempted from GST?
So, Prashant, good morning to you and to all your viewers as well. So honestly, I think at this point of time, I think let's wait for the final things to get fructified. I'm sure the relevant committee is looking at all the contours of what to exempt, where to reduce the rates, etc., etc. And I think obviously we will kind of evaluate the impact of that as and when that gets announced. But having said that, I think where all of this conversion is largely discussions are largely coming from is the fact that I think when you look at it in the context of health, I think the potential for growth is significantly long term. And therefore, in that context is where I think equally there's a thought process to kind of make sure that the buying of the insurance process also becomes largely affordable insofar as policyholders' interests are concerned. I think that is where pretty much large part of this conversations is coming from. So honestly, at this point of time, let's wait for the final announcements to happen, and then maybe we will be able to come back and specifically talk about what does it do from an overall market perspective, and let's say even within that, let's say so far as ICICI Lombard is concerned.
Mr. Balachandran, we're just sort of discussing theoretically speaking, so we're not going to hold you to anything. Of course, it's for the government to decide and they will decide. But since we have you right after this weekend announcement, so it's very much on the anvil, exactly what we'll know. But I'm just trying to understand, you must have already, you must have it offhand. If it's senior citizens under 5 lakhs, what proportion of the business is from those segments, sir?
Yeah, so to be honest, Prashant, as I said, at this point of time, we haven't kind of done specific impact assessment because honestly, we will wait for some of those announcements to actually get fructified. And then I think we will obviously be able to come back. I think what I can tell you for sure is if you look at in general, I think the thought process from a customer standpoint is to significantly look at possibly increasing the extent of coverage that an individual or their family or let's say even a corporate that wants to take a cover for their employees are concerned.
Got it.
So in general, we're seeing an increase in the coverages that one is looking at.
There's no reduction in premium?
So honestly, as I said, insofar as if there's a reduction in rate, then to that extent, as I said, it kind of largely becomes affordable at the hands of the policyholder. And therefore, to that extent, what does it translate into any impact? Because at the end of the day, whatever tax that we collect on the GST is effectively that we end up remitting to the government. So hence, to that extent, which is where I said, we will obviously wait for the final announcements to happen, and then we will be able to come back and tell you what the impact could be, if at all, for the market and for ICICI Lombard.
Oh, absolutely. And of course, policy holders will absolutely love any sign of reduction in premiums for sure. Mr. Balachandran, good to have you on. Thank you very much for joining in. So just to talk about the other aspects of the results, and I think the debate here is that you've had great growth, right? I mean, I think about a 17% growth when it comes to premiums. But there is also a little bit of an increase in underwriting losses. The combined ratio has gone up. So just contrast this for us. Why the rise in underwriting losses? What are the really two different trends?
Yeah, so that's a great question to ask. I think, so again, if you look at from a thought process standpoint, I think from an ICICI Lombard standpoint, I think you would have always heard us talking about profitable growth as a theme. And therefore, to that extent, I think we stay committed to that in terms of whatever growth that we are driving across the preferred lines of businesses. But if we look at the inherent nature in the way how accounting of revenues and accounting of cost takes place, you will always find in periods of uptick in growth a relatively higher outcome when it comes to an absolute underwriting outcome. The reason being, whatever premiums that we kind of underwrite, that gets earned over the contract period. Let's say if the policy is for 1 year, then the revenues will be earned over a 1 year period. However, any costs that we incur with respect to sourcing those policies, they get expensed out immediately in the period in which it is being incurred. So to that extent, there will always be an element of an underwriting adverse outcome if you were to look at the time of writing the risk. This possibly gets addressed when you look at the combined ratio point that you referred to, because that takes care of this possible nuance of revenue getting earned over a period of time and expenses getting upfront impacted. Now there, if you look at the combined ratio number, for Q2, I think that the combined ratio looks like at about 104.5. But again, as we kind of explained also on the earnings call, this quarter specifically, we did see a lot many more instances of floods happening. I mean, there were floods pretty much all across, whether it's Gujarat, whether it's Telangana, whether it is North India, etc., etc. And that's the reason every time we also carve out and separately put out the impact of our results, excluding the impact of these flood events. And there, if you would have looked at again, this 104.5 will translate to about 102.6%. And this 102.6, if you were to look at on a like-to-like basis of Q2 of last year, again excluding flood impact, that number was about 102.8. So actually, we have actually seen a small positive improvement insofar as our combined of from 102.8 to 102.6. And what we've also been telling the street is to kind of, we stick to our thought process that we have, which is to get to an exit combined of 101.5 by the end of this year.
All right. Hi, Mr. Balachandran. Good morning and good to see you. And, one part of the street will say, why do we have to make these adjustments? And hopefully in the coming quarters, there are none of these adjustments that they'll see. So for the first half of the year, you have done close to 9,500 crores of premium collected. Last year, you did ballpark close to around 17,000 crores. Going by the first half performance, for the year, should we look at premium collected at around close to around 20,000 crores with combined ratio at 101.5%?
So, Naishal, it's a good morning to you and so to your point on the in terms of the combined ratios, I think you're absolutely right. I think what we do pencil in at any point of time is obviously a stated number of catastrophic events that one would kind of possibly see happening through the year. But unfortunately, if you look at in terms of what's happening on ground in terms of possible impact of climate change, there seems to be a lot many more unprecedented instances of floods happening across the country. And that's something that we would have to obviously wait and watch in terms of how that plays out for the market. And therefore, to that extent, in terms of what it does for ICICI Lombard. But from our standpoint, I think we obviously want to give that impact separately called out. But what we will hold ourselves is obviously to drive the combined ratio at a company level. In response to your first point. On the point on growth, I think if you look at last year we ended the full year with an overall gross revenues of roughly about 25,000 crores. Now, in that context, when you look at the first half of this year, I think we have kind of, as we indicated, we have grown by almost about 15.5%. With a combined of on a half-yearly basis of about 103% thereabout. At least insofar as the road ahead is concerned, I think we believe, and this is something that I talked about even at the end of Q1 earnings call, which is relative to wherever the industry would kind of end at, we would obviously want to see ourselves with a delta at an aggregate level of at least about 100 to 200 basis points, assuming the market remains sensible in terms of pricing and discipline. And that's where we stand committed. And that's also, which is the reason why I said, from an overall growth standpoint, we could expect the industry anywhere between early double digits to early high teens. In that context, we would obviously want to see 100 to 200 basis points growth over that and exit Q4 combined ratios at 101.5%.
Okay, Mr. Balachandran, just to go back to that point, I know you were telling Prashant that one has to wait and see the final outcome of the GST announcements before knowing the granular impact. But I mean, at a thematic level, whatever is the ease off in tax that's allowed, whatever percentage it might be, or if it gets waived off for a certain category, I mean, will it be a full pass-through, or will it still leave you with some elbow room and some leverage? So if you could give us a general sense on how premiums will move on the health side. They've already been moving higher, but what is the further appreciation? And then any tax relief, will it straight away be a pass-through and will it go to the end consumer?
So that is exactly the reason why I kind of spoke about that, Surbhi. That's the reason why I said I think obviously we will have to wait for some of those contours to play out. And so hence any of these announcements, we'll have to look at it in the context of in terms of is there a reduction in rates? Is there an end-to-end kind of a pass-through insofar as the entire transaction in the context of health insurance is concerned. So all of those factors is something that one will have to kind of get to as and when we will get more clarity. And that's the reason why at this point of time I had said that we will wait for this announcement to play out before we can kind of commit specifically in terms of what does it mean for us.
To push you for one number, Mr. Balakrishnan, I asked you about the net earned premium, which is at around 9,500 crores. You briefly spoke about the gross premium for last year. For this year, the net earned premium could hit 20,000 crores?
So, Nigel, if you ask me, I think for us, what we would largely look at is a growth in revenues because, as I said, earned premium is purely a function of how that income will be earned over the contract period. And hence, a better metric to look at will be more the gross premium numbers, which I said full year we ended at about 25,000 crores. And on a half-yearly basis, our growth has been roughly about 15%. And so that's where we kind of stand at this point of time. And depending on how things play out, I think we stand committed to that 100 to 200 basis point possible alpha over the industry growth numbers, subject to market remaining disciplined. And on the bottom line, exit Q4 combined ratio is at 101.5%.
Okay, all right, Mr. Balachandran, we leave it there, and we hope to have you back with specific numbers on, when we have the final decision on GST from the government. Thank you very much for joining us with that perspective for now. 100 points lower, so for the market, I think there's a bit of a bounce which has played out. We were down 150, and there is some recovery, but 24,740 is where the market finds itself at right now. Lots of stocks moving around, and that's going to be the focus as well. We're going to take a quick break here. We get you a quick exclusive conversation with Rajiv Bajaj, Managing Director of Bajaj Auto. That's coming up. Stay tuned.
Welcome back. You're watching CNBC-TV18. Now, Bajaj Auto has been in the news after the company delivered in line with estimates as far as the Q2 results go. But there was a drop in stock price last week to the tune of about 12%, largely due to a weak commentary on festive sales. Now, to explain what's happening and what's probably going wrong with the festive sales, we're now joined by the MD of Bajaj Auto, Mr. Rajiv Bajaj. Mr. Bajaj, thank you very much for joining us. We also spoke to the Federation of Automobile Dealers, who believe that two-wheeler sales growth in the festive season will still be in double digits. But Bajaj Auto has slashed its festive estimates to 3 to 5%, which is below industry expectations. Why is that?
Good morning, Parikshit. The short answer to your question, Parikshit, would be that I think the FADA is likely to be correct, and let me explain why I believe so. When we are talking of festive sales, before we talk of the numbers themselves, we have to dwell a little bit on the qualitative context in which those numbers are being delivered. What I mean is that everybody is talking about the growth in terms of the Vahan registrations. But the other important information is the dealer retail to customers. Now, the Vahan information is the correct basis for discussion because that is in the public domain, whereas the dealer retail to customers is obviously, the private domain of each manufacturer. What happens in a typical month through the year is that this retail lags the registration by a few days to a week or a little more, depending on the state that we are talking about. But at the festive time, the gap becomes considerable. For example, I can tell you, on the day of our board meeting last week, our motorcycle Vahan registration was only about 2/3 of our dealer retail. Now, this happens particularly so every few years in a month like this October, where you have a double whammy of Dussehra and Diwali, of course in a positive sense, happening in the same month. That tends to completely overwhelm the RTOs and the dealers, and customers also obviously get very busy in a month like this. So I think what is happening here is that when you use the same instrument to measure this month as you do the rest of the months of the year, you are likely to capture a moment in time which does not represent the holistic picture. So, what we said about the growth as it stood in terms of Vahan registrations about 10 days back was based on the data at that time. But as the weeks evolve and we come to, let's say, early December when Rakesh will speak with CNBC again, we may well turn around and say that now the growth is closer to double digit and not lower single digits.
So what would be your estimate as of now on festive sales from Bajaj Auto?
Okay, so let me give you the bigger picture. First of all, the data that we are all seeing in Vahan is a composite two-wheeler data. It doesn't give you the breakup. So each company has to kind of infer for itself, and of course we informally compare with each other. So there is a component of scooter and moped sales that I cannot comment on because we don't participate in the scooter and moped segments. In motorcycles, again, as you are aware, there is a trend over the last several years that the 125cc plus industry, which used to be about 35% of the domestic motorcycle industry, is now up to 55%. And obviously a trend like that is not going to reverse. And within that, Bajaj Auto has been, in particularly last few quarters, really going from strength to strength. And again, a company's portfolio cannot go sour suddenly overnight in a particular month. Now, to answer your question more directly, based on how we infer the breakup in the Vahan data, we are seeing ourselves at this time in the 125cc plus segment, which is the segment of our focus, growing about 40% higher than the industry rate. And that has been the trend for the last so many quarters, because of which we are close to market leadership in that segment.
Right. So 40% growth in the 125cc plus segment. Has anything been a drag on festive sales, something that you had not anticipated?
I must correct you, Parikshit, if I understood you right. We are not growing at 40%. We are growing 40% faster than the industry in our understanding. Now, coming to what may be some extraneous factors, as you asked, well, there is one which is simply this, that the 100cc market right now is faced with very steep and deep discounts by two of the largest players. And as I mentioned before, that since this is not an area of focus for us, we do not have, if I may say so, a rupees discount on our products in this space. So as a result, one may see for a short period of time till the end of the festive that both the 100cc industry, which has come down to about 45% of the total industry, may show a little bit of an uptick. And similarly, the shares of those who are discounting are also going to show a little bit of an uptick, because this is nothing but basically preponement of sales from subsequent months, because you don't change the trend, the customer trend, with a 5,000 rupee discount on a 1 lakh rupee product. And one might say that, okay, this is the choice Bajaj Auto has made to stay away from that, and that may, in that sense, show us in somewhat poor light in that segment at this point of time. But then, Parikshit, business is not just one-dimensional, right? It's not just sales. It's also on the bottom line. I mean, there is a reason why our EBITDA percentage is double that of the industry and market cap almost thrice of the other major players.
Any plans to cut back on production here onwards and for any particular segments?
Well, not really. In fact, I can tell you we are going flat out in October, because obviously this is the peak month. We have to go flat out in November also in terms of production per day basis, because the Diwali holidays take away 3 or 4 working days at that time. And even when work is restored, there is disruption due to absenteeism. And I can tell you the main reason why we need to go flat out is not only because our domestic portfolio continues to do well. If you have some time later, we can talk about especially the Freedom, the Chetak, the Triumph, the KTM, and of course the Pulsar, and of course the three-wheelers. We are looking at a 50,000 plus per month sales for the three-wheeler in both October and November, if we can produce that. But I must share with you that we are seeing really good traction finally with exports. It's a question that CNBC anchors have been asking Rakesh for the last year or so. Last month, as you're aware, we clocked exports of 156,000. After a long time, we exceeded 150,000. This month, we are looking at 170,000. And next month, I believe we should be closer to 180,000, which is, near our pre-COVID normal of 200,000. So that is what is going to mainly drive the factories incrementally this month and next.
Right. I would also like to ask you about, you've already answered that you are possibly going to see double-digit growth when we see your numbers by December. What will be the growth drivers here onwards for Q3 and Q4, according to you?
Well, I would say, Parikshit, they will be the same that they have been in recent quarters, starting with the Freedom, the CNG motorcycle. I am pleased to say that we seem to be on course to make and sell as many as 30,000 Freedoms this month. And all of that, as per the data that I see in terms of retail, is getting retailed out, and they are bound to show up in registration by the end of November. Rakesh has already said that he needs capacity up to 40,000, and I know that he's sitting in Brazil and contemplating the next incremental step for capacity on the Freedom. So that's really good. The Pulsars will continue to drive it. If you again look at Vahan data for the states where we were relatively weak in Pulsar, like the large markets of UP, Bihar, Jharkhand, West Bengal, we have gained a lot of share in the recent quarters. The new Triumph's been received really well, and in the next quarter, that is the last quarter of this year, you will see 2 or 3 new KTMs, which, for me at least, are very exciting. They are all new. These are not upgrades. These are completely new KTMs. The Chetak, I think with a bit of luck, we can strike 30,000 again on the Chetak this month, which is well above our capacity. So we've done a lot of work to improve productivity there. That, as I told you last time we spoke, we are pushing up to 40,000 by April next year. And of course, the three-wheeler is doing well, and the exports I just told you about. So I think, on all these 6 axes, the growth is continuing nicely, and if I may say so, profitably.
Right. In your Q2 earnings call, your team said that a refreshed range of Chetak will be out by mid-November, and this will significantly improve the margin structure as well. What can customers expect from the refreshed range of Chetak?
Well, yes, it's true that from mid to end November, up to Jan, in that period of about 2 months, we will refresh the entire Chetak portfolio, and we will give consumers even more of what they desire at the core of an electric scooter. First and foremost, reliability, because I believe Chetak is today considered perhaps one of the most reliable, if not the most reliable, e-scooters in the market in every sense. For various reasons, I won't go into those details right now. So more reliability, we will have a bigger battery, so obviously more range, better charging capacity, a little more of some of the more secondary attributes like storage space, floor space between your feet or ahead of your legs. Stuff like that will just make the scooter more comfortable. And yes, from our point of view, there is a very significant reduction in costs with this third or fourth generation Chetak. So I'm happy we are moving up that learning curve really nicely.
Right. Specifically, I would like to ask you about any plans to prepone any launches. You've mentioned a refreshed Chetak range. You've mentioned new KTMs. Anything that you plan to prepone to excite the sentiment?
Not really, Parikshit. That's not possible. I mean, in a certain sense, we always, our product plans are always a function of the overall capacity in the organization. So it's difficult to prepone something just like that. But yes, I will say that the one thought I had shared with you that we would like in the next financial year to participate in the e-rickshaw market as distinct from the e-auto and e-cargo, which, by the way, we are doing very well. Again, you have seen last month's Vahan data. I'm sure that we are, neck to neck for leadership there in just 15 months after launch. So I think the e-rick will take our three-wheeler business to a completely different level. And that is something we want to start off as early in the next fiscal as possible so that we benefit from it throughout the year. So that would be one, but otherwise, no change in plans.
What would be your outlook for full FY25? This is something that a lot of people would want to know.
I think in the first half, our cumulative volume, two-wheelers, three-wheelers, domestic exports, everything put together, Parikshit, is a little more than 2.2 million, if I remember that right. And I would say, on the one hand, it would be at least that much, which means about 4.5 million by the end of the year. But I suspect it will be a little more than that for the reason that if you look at the export component in the first half, it is about 850,000 vehicles, two and three-wheelers put together, which means about 140,000 a month in the first 6 months, which, as I just shared with you, we are looking now at numbers like 170, 180 a month. So, if we are going to on an average, and again, this changes by the month, so I may have a different number for you by December or January, but as things stand now, if we are going to have just exports go up by 25,000 a month for the remaining 6 months, then that itself will add 150,000. Hopefully a little more traction in domestic sales. For example, we just launched in the last week a very, very nice, sweet new Pulsar 125. So, this, and of course, the production of Freedom and Chetak going up. So all of this should point towards something like 4.7 million, something like that. But I think Rakesh is a better person to answer this question.
All right. Do you think the stock price correction that we saw last week, was it mainly due to the low festive sales outlook?
I don't want you to get me to do a musk here, but I don't know why the stock corrected. I mean, a stock that has grown by almost 100% in 12 months has to correct at some point, I would imagine. But as far as I am concerned, I stand by my projection of 20,000 rupees as the long-term target price in my head. Not that I am the expert of this subject, as I've always said, but more importantly, I am certainly, if I can, going out and buying some stock because something that corrected 20%, perhaps based on a somewhat temporary understanding of an evolving situation, presents a nice upside in the weeks to come.
Right. Certain brokerages have downgraded the stock to sell from reduced, citing high valuations amid normalizing growth. How would you address concerns on the high valuation of the stock?
I don't think as a manufacturer we can do anything, Parikshit. I mean, it is typical of the stock market that it will lag for some time and then it will suddenly rise and then it will run ahead and then it will correct. So I think this is the volatility in the cycle that allows people to make money when they buy and sell. So that is the nature of the territory, that is the nature of the beast. We have to stay focused on the motorcycle market.
Right. Finally, just if you can leave us with an overall outlook on the festive season, you expect double-digit growth when we look at the numbers in December finally, Mr. Bajaj?
Yes, I would say so. Particularly, I must emphasize for the area of our focus in the domestic motorcycle segment, which is the 125cc plus. Certainly, that may not be the case in the 100cc. If I may say so, we couldn't care less. And of course, particularly with something like Freedom and with the Chetak in the e-scooter, that growth is going to be tremendous. I don't even want to try and calculate that number. Three-wheeler is going to be, a handsome growth, and exports looking really good. So, that would be the big picture for the company as a whole.
All right, Mr. Bajaj, thank you very much for joining us with some of those clarifications and how you expect the growth to be strong across the company's segments in the months going forward. On that note, we're taking a short break here on CNBC TV18. Much more on the other side.
Welcome back. So let's just get back to the market after that very interesting conversation with Mr. Rajiv Bajaj. There's some attempt at a recovery. And just to quickly talk about the stocks, on the upside, Nifty is now nursing about a 50-point cut. HDFC Bank, the biggie, is really fighting like a titan, almost 4% higher on HDFC Bank. That is the biggest counterweight. Because aside of that, there's also Reliance, which is at least not falling. Between these two, you have the bulk of the firefighting. Otherwise, of course, still has been a negative morning. But speaking about stocks that have at least not disappointed, have actually done pretty okay in terms of the expectations. Tech Mahindra can be counted in as well. Along with HDFC Bank, it's also, chipping in. Rima is joining in. Rima, tell us what worked this time around for Tech Mahindra.
Well, it's a stable quarter for the second consecutive quarter now. The company's constant currency revenue growth of about 0.7%. Remember, Tech Mahindra has a new management in place. They've put in a turnaround plan. They expect by FY27 the company will be at industry-leading growth rate and margins of 15%. And the analysts believe that what we've seen over the last 2 quarters is a step in the right direction towards that. The key verticals, telecom, which is 33% of their overall revenues, and BFSI, a focus area, are both firing for the company. There is still margin improvement, 9.6%. Profits have gone up 47%. Nomura says there is a turnaround underway, a steady progress towards their medium-term goals, which is why they have a buy call. But Jefferies is not very bullish on Tech Mahindra, an underperformed rating. They say Q2 revenue beat was encouraging, but they still see the company's aspiration of achieving 15% margins as optimistic. Valuations at 26 times forward multiple looks rich. So which is why they have an underperformed rating. But as I said, Q2 was a good set of numbers and the company is on the right track. Back to you.
All right, Rima, thank you very much for that. From the good to the not so great, Tata Consumer is still bearing down. Almost 7-8% decline on the stock today. We've got Mangalam joining at 8.5% right now. Let's go back to Mangalam to figure out where the misses are. Mangalam.
Well, it's a sub-1,000 rupees stock now. A big 8.5% cut is what we're seeing on Tata Consumer. And here's 5 reasons why. The first one, of course, is that their India beverages business, that did not do too well. Remember, Tata Consumer was earlier known as Tata Global Beverages, and beverage business actually underperformed with 3% revenue growth cut and 4% volume cut as well. In fact, they lost market share in tea to the tune of almost 20 basis points. The second part, ready to drink, which was a fast-growing business for them, actually saw competitive price action and also unfavorable weather conditions. So that impacted their revenue by almost 11%. The third part, their growth businesses, which the company had guided for being 30% of their business and growing at 30%, as a result of the above mentioned, grew just about 15%. Foods business as well, the organic revenue growth was just 9% and volumes grew just by 1% as well. Management has said that it is the tea business which was impacted by subdued category trends, and they are starting to see synergy benefits from Capital Foods and Organic India, and that's where the silver linings lie. The first one is international margins have actually seen an improvement of nearly 500 basis points. Acquisitions, both Capital Foods and Organic India are doing well, but the problems are far too many, as a result of which there have been a lot of brokerage downgrades as well. So we have ICICI Securities, which has trimmed their estimates, earnings estimates by 7 to 8%, downgraded the stock. Goldman Sachs has actually cut the EPS estimates by around 10 to 14%, and Morgan Stanley too has said that market share over margins is the key near-term concern. They too have cut their target price.
Okay, all right. Got it, Mangalam. Thanks very much. So that's the one that's taking it on the chin right now, along with Kotak Mahindra Bank. As we sign out of Bazaar, let's just pull up that stock as well, because there's no recovery right now on Kotak. Those asset quality concerns really bearing down. So there you go, almost 6% on Kotak. Tough morning for the bulls. That's where we take your leave on this edition of Bazaar. Stay tuned. Chartbusters coming up next.